All right, it's recording now.
All right, so we're going to kick off with revenue. Revenue is basically just keeping account of all the money that is coming in from your sales. As you can see here, the way we did it, we're a product-based company. So product A, that's going to be the Dencil. That's the main thing that we sell. You want to keep track of the number of units that you're selling each year. And then by making sure you realize what the price per unit is, you can multiply that and get the total. So you can see down there in cell C9 through G9, you can see the total revenue that we're going to be bringing in each year from the number of sales of the Dencil. And then if you scroll down, you could see the net revenue, kind of just makes it easy for us to see. And then it's important to realize how much revenue you're going to be coming in with per quarter and per month, because you have monthly expenses and you got to hit your quarterly goals. So we made sure to record that all the way down there as well.
Okay, so moving on to the cost of revenue. Here we have our product A, which is the Dencil, and each Dencil approximately costs $2 to make, and that's pretty much the only cost that we need to take into consideration. We multiply that by the number of sales for each Dencil that we have for each year, and then we have our total costs for the total amount of Dencils that we make for each year in this row here. And if we scroll down a bit, we can see the salary expenses for the employees that we will be paying for, to make these Dencils. We will also be renting a facility. I believe it's a 1,000 square feet in order to make these Dencils, and this these $6,000 here every year takes into consideration the price to rent out the space as well as the utilities. And then if we scroll down a bit here, here's a bit of the allocation of the costs of revenue here. We have our variable and fixed costs. And then if we scroll down a bit further, here's our total cost of revenue by month and quarter here for the first five years that we'll be operating. That's about it. On to operation expenses.
Okay, so when it comes to operation expenses, when you first look at it, it's year 1, 2, and 3. When you notice the jump from year 2 and 3, it comes when we start paying ourselves. Also, the posters and raffles, that's part of the marketing scheme, or just trying to get it to be known towards the market. So that'll be adding up. When we go down to where we at? Ooh, we're going down to total general to general administrations. That's just the same, especially with the renting utilities, because as what Marco said, we found a 1,000 square foot that comes out to 5,500. But with the utilities, that's just an extra 500 to stack on. It's located in Henderson, which is going to help with the traveling costs. With the sending it out and also taking in. So our plan is to, like what Marco said, the first 2 years, you're not going to really see a lot of accumulation of money, but that third year is when you start seeing us start intaking it. Maybe scroll down some more. We go down to sales and marketing over the monthly quarters, which is all projections. And then you go to general administration, which has already been said. And then we're going down to, was it Danny?
Yes, sir.
On to the personnel.
Mm-hmm. Okay, so this is our personnel and salary sheet. So as you can see, for the first 2 years, we're not going to be paying our 4 main officers, the 4 of us in the group right now, for the first 2 years, because our revenue isn't high enough to have a sustainable salary for the 4 of us. So those first 2 years, we're not going to get paid. By year 3, we're going to get paid, all of us, an even fixed amount of $2,000 per month. And then on year 4, we'll be paid $3,000 per month. And then on year 5, we'll be paid $4,000 per month. So 24, 36, and 48K over the years 3 through 5. We also have a 15% on our benefits, so that's added to the total cost. And you could scroll down a little bit. And then here we have the salaries for our hourly personnel at the Henderson manufacturing plant. So the first 2 years, we're going to have 2 employees to help manufacture the Dencils. They'll be working, I believe, for $10 an hour. Yeah, 2 days a week, $10 an hour. And that should lead to the $8,300 per employee. So $16,000 for the first 2 years for the 2 employees. Then it goes to 24, and then so forth. And yeah, that's our personnel.
Okay, on to I believe the income statement.
Yep. So the income statement pretty much brings it all home. This is one of the most important financial sheets and accounting sheets in all business. Tells you where your revenues are coming from, where your costs are coming from, and helps you calculate your gross profit. Profit's the name of the game in business, and this income statement is what helps us bring it all together and figure out what we're really going to be making once everything's all done. So you can see at the top, there's the net revenues, and that's basically what we talked about in the first sheet, is realizing how much money you're going to be bringing in. Marco talked about the cost of revenue. It costs things to make things. So we want to know how much it's going to cost to make our product, and it shows that right there. So it calculates the difference between the net revenue and the cost of revenue to get your gross profit. And from there, you have all your operating expenses, and that's just business expenses such as marketing. We talked about how we're going to be doing raffles, putting up posters, putting up online ads, research and development. There's not really much of that needed for where we are right now, but the general administration that goes to the like the overhead of the manufacturing facility and salaries and whatnot. So those are operating expenses that are going to be to take it away from our gross profit. And if you scroll down, we get into other expenses that we're going to have, such as interest. If we had a loan, we're not really going to need too big of a loan. It's only $5,000 a grant from the university. But if we did, that would be calculated in there more. So we want to figure out what we're going to be making before interest and taxes. And then once the interest of a loan, we don't really have one, would come in, that would detract from it. And then if you want to scroll up, and then we have to deal with taxes. So we didn't make enough money to be taxed the first 2 years, but year 3 through 5, we made a pretty significant amount of profit. And so then we got taken into the 40% tax bracket. So after that, whatever our gross profit was, we got taxed 40% on that. And once you subtract that, we're able to see the net earnings. So net earnings is what you made after everything at the end of the day. As you can see, year 1, we came out a little bit in debt. We didn't quite break even. So we need to either sell more units or find ways to cut costs, or sometimes it takes a year or 2 to break even in business. But year 2 through 5, we were making a pretty good profit, and we're able to show that through the income statement.
All right, so that about sums up our spreadsheet. Thank you for coming.